fundsupermart.com.
Relative to the large cap sector, what are the opportunities investors can uncover by investing in small and micro cap US companies? What are your preferred sectors and themes?
Well, we don't always judge ourselves versus the large cap names. What we do is tend to see that the small cap names relative to the big cap names do better in an environment where there is growth. With our fund in particular, we just need a little bit of GDP growth because our fund is a turnaround fund essentially. And what the managers of these companies will tell you is that while it's good to have new products and it's good to have maybe some new people, new salespeople, nothing beats a little wind at your back, a little GDP growth. And we think we're in that situation right now. The sectors that we like, the main ones are natural gas and energy in particular, especially in North America. We also like technology, and we also like some of the consumer names as well. We tend to do things on a name-by-name basis, but when you see one name in a given area, like say, for instance, energy, what you tend to find are other names in that same area where you're getting the same types of statistics. We like to buy very, very cheap stocks. Natural gas, we think, is a pretty much a game changer for North America. The relative cheapness, if you will, of the commodity versus other places in the world is just so dramatic that we think it's going to have long-term effects, not only on industry, but also on employment and the nature of the business itself.
Under what environment are small and micro cap companies expected to outperform the large cap counterparts?
Well, what tends to happen is that when things get better or when you get an improving economy is that the market tends to favor the bigger names, the names that people are more familiar with. But as those names become fully valued or more closely fully valued, the small caps tend to start to rally then. And when there's a broadening of the economy, margins and leverage really favor the small names. So as the cycle matures, those names tend to really give you that outperformance that you really need for small caps, because if you're going to take on the risks of investing in small caps, you certainly should be paid for it. And that's the environment that usually, or that's generally the way that the market reacts to growth.
How big is the team managing the fund, and how deep can their analysis go in view of the fact that the fund holds more than 250 stocks, which is only a fraction of the investable universe?
Right. We have a team of 4, and we meet daily to discuss the portfolio. We go over each name in the morning and decide where we're going to add, where we're going to pull back from. We have always worked in a small team, and we've always had a large amount of names in the portfolio. We average between 250 to 300 names. We don't believe in concentration. With the risks that are inherent to small cap market, we like to have our investments very, very broadly diversified. We don't want to be in a situation where one mistake could ruin the performance for the year. It is a huge universe that we could pick from. There are over 6,000 stocks, close to 7,000 stocks. But we tend to really look at those things that are, number one, cheap. And when we say cheap, we mean have a very, very good price to book and price to sales ratio. And also those things, just importantly, that offer some sort of upside for a meaningful change in the next year and a half to 2 years.
Based on the latest fact sheet reporting, the Legg Royce US Small Cap Opportunity Fund has a cash position of almost 10%. Can you explain the rationale for this high level of cash holding?
Sure. We generally keep cash between 3 to 7%. The only time when it goes higher than that is if we've gotten a lot of inflows, which we've had recently, or when there's been a lot of M&A activity. We tend to sell out positions where there's a bid for the whole company, leaving the difference for the arbitrageurs. So the normal percentage of cash is 3 to 7%. We don't ever get defensive and build up cash on purpose. Again, the reason why there's that much cash in there is because we had gotten some inflows. We tend to spend our money in a pretty deliberate fashion. So if we were to get, say, a large sum in, it's not unusual for us to take a little bit of time putting that to work.